Okay, thank you, Steve. So I don't think we're going to be as exciting as the beginning of the day, unless we actually do like a wrestling match or something, which I did consider, but we're not going to do that. So manage your expectations. I'm super privileged to be able to have this discussion or moderate this discussion with this esteemed panel. To my very left is Danny from Ryan Specialty. We have Joe from Fermat, Chris, Vantage, and Bob, of course, from MultiStrat. You guys can read their bios. They're lengthy. They've been around for a while, so they're old, actually. No, I'm kidding. I'm kidding. If you weren't here earlier, you won't get that joke. But okay, all right. So I'm going to do a little bit of kind of scene setting here to get us going. So over the past several years, the ILS market has undergone one of the most, at least in my opinion, significant evolutions. What began as primarily property cat, as we all know, as an asset class has now expanded meaningfully, actually. And so into casualty, specialty, cyber, areas that are now experiencing real momentum. Casualty lines, for example, now account for more than half of direct premiums written in the E&S market. In fact, the E&S market has had 14 straight years of premium growth, a lot of that being casualty. At the same time, cyber has become a compelling growth frontier, which I hope we're going to talk about today a little bit, with over $840 million deployed into underwritten cyber cat bonds. And this is the one that's super interesting to me. I hope this is a good stat. I think Joe verified it, but there's 20 to 30 investors now investing into that space where it wasn't that long ago where there was a handful. So that's a real expansion as well. During the expansion, we of course now have some new investor pools, which we also are going to talk about today. You know, that's really reshaping the way things get structured. And really, I think, is a very different space for us from the property cat origin. So today's panel brings all these leaders together to really talk about that expansion. So where are we going? Is it sustainable? How do we feel about that? And then what does it mean for the industry going forward, which I think is going to be a super interesting conversation. So with all of that, what I'd like to do is start warming you guys up a little bit around a little bit of a health check on the asset class. There has been a lot of change. We've gone through lots of different things. We had the wildfire last year in January. You know, how do you characterize the current market dynamics and just the health of the asset class? And I'll just go straight down the line, if that's okay. Danny?
Yeah, maybe I will start off with a firework or two. I do think that it's bearing hallmarks of a healthy marketplace. That being said, when you compare it or juxtapose it to traditional asset classes, real estate, FX, equities, fixed income, it is still very much in its nascent infancy. And we would all be well served to take a nod to that there's a lot more that we can and are doing to fortify and strengthen the health of this evolving but pretty exciting asset class. I don't want to dismiss the fact that there's so much more that we can and we are doing as an industry, and we're a small group, right? If you look around the room, this is pretty much us in the ILS space, with exceptions. But healthy, but I just want to hedge that with there's still a long way to go.
Joe?
Afternoon, everyone. Kathleen, I think the health of our industry is probably at an all-time high. Because I think for the first time, and talking to my colleagues and peers, maybe in the history of this market, we have this sustained, synchronized balance between supply and demand. In the bond market, just as we're seeing, and we heard Paul speak on the most previous panel, sponsors coming with more volume to the market, we're seeing more investors wanting to allocate more capital to this market. And that's a very healthy growth situation. And that's, to your point, Danny, is something we need to keep in mind as we continue to grow and expand, is keep that synchronized, sustained, synchronized balance of supply and demand.
What could disrupt that? So what do we have to be careful of there? Because that has happened in the past, right? Where we get an oversupply one way or the other.
Well, absolutely. In the context of new markets, which we're talking about, I get so easy to get excited about new markets, right? And but there's two things I think as ILS people, managers, investors here, we can't oversee two things. Underwriting discipline, I think, is critical when we look at new opportunities, and capital management. I think I'm not the first one to say this on the panel today. Those two things are critical to keep in mind as we see new opportunities. So we sort of think of three things that we look for when there's a new market. There's one, there has to be some kind of protection gap. There has to be some kind of need for additional reinsurance capacity. The need has to be there. So you're talking about a growth insurance market, and that's what we're seeing. We're seeing insurance markets grow everywhere, this country, around the world. Then you need to be able to underwrite that risk and see an underwriting profit there. And third and foremost, you want to be in a position where cedents actually want to share this risk with investors. And there was a time when that wasn't the case. There was a time, I'm sure there's people in this room that remember, it was very difficult to get a cat bond sponsored, right? But we're increasingly seeing cedents and sponsors wanting to share this sort of strategic risk with us across a broad line of businesses that you've already mentioned. And I think that's the third prerequisite that you need for there to be a win-win. Okay. So that's what I would say we have to keep in mind as we expand, and I'm happy to have others.
Chris, how are you feeling about the health of the asset class?
Thanks, Kathleen. I first of all agree with Danny that it's a relatively small industry, and it's been pretty closed for many, many years. And it's finally opening up, and we're going to get a lot of interesting critique and feedback from other industries, other sectors of the economy that we should heed. It might come in different forms and might be somewhat hard to hear, but we can all improve and do better because of the protection gap. The protection gap is real. There's more and more risk in our economy, in our globe every year, whether it's emerging risk, climatology, increased interconnection between economies. We all need to grow. So I think it's super exciting that we have finally got to a watershed moment where you're not explaining. You go back to Ken Fruit, if anybody knows who Ken Fruit is, who wrote a paper in the 80s around insurance as an asset class. We're not having to convince people of that. Witness this, the room here today. It's I can't say this word, orthogonal risk to an investor portfolio. And that we've overcome a major sort of watershed moment where now we can discuss the different varieties, and we will do that today on the panel, of insurance risk that we can bring to a securitized fashion to investors to improve their own portfolio and investor experience. So I think it's amazing that we're finally getting to that point where we're not an afterthought or a small sort of offshore, misunderstood industry, and will be much more relevant in the conversations with investors, all kinds of investors going forward. So very excited.
Excellent. Bob?
Yeah, I think I'd just take a moment to say, if I think about the first time we put a casualty reinsurance transaction together, backed by direct capital from an investor, was 2014. And give a shout out to my friend and former partner, Jim Robinson, in the back of the room, who helped found MultiStrat. It was tough going. Okay, talk about Joe's point about you couldn't sell a cat bond. Believe me, you couldn't sell a casualty deal. People thought it was crazy. It'll never work. Today, I think about all of the points that have been made, but as well as the signs of a maturing product is that you see increasing sophistication, you see specialization of participants, and you see a growing level of demand. And we have all of those now. We have increasing structures within what we're building, whether it be forward exit options to create duration opportunities. It includes, fronting aggregation, aggregate stop losses, equity and debt tranches. I mean, we're starting to talk about things that are really evidence of an evolving, maturing, not mature, but maturing product opportunity. And the investors are really responding to it. So I think it is an exciting time.
So I'm actually going to follow up with that. Around why do we think that that's happening now? Because it has sort of been something we've been talking about trying to do for quite some time. In fact, I think probably for all 10 of these conferences we've talked about, how do we expand, how do we grow? So why? Why now? Why is casualty taking hold? Why is cyber now getting more traction? Why? What is it about now that's making that happen? Danny? Yeah?
I would say there's a lot to like. There's a lot to like about leverage. If you think about other asset classes, if I want leverage, I'm going to go and get treasury rate to borrow money to go invest. Well, I can get leverage 3 or 4 times in these casualty transactions. It's awfully attractive. So there's one. I'll leave the rest to Joe.
Okay.
She's the
Well, I would just say it's not diversification for diversification's sake. That's one thing I want to make very clear, because I think in some investors' mind, particularly when it comes to Nat Cat, is sometimes diversification. This is not what we're seeing, and not what we're seeing at Fermat. We're seeing a supply-driven demand for sponsors and cedants to start thinking about alternative reinsurance capacity in all sorts of lines of business, not just property cat, obviously property cat for sure, but increasingly they want to share this risk with investors. So the question is why, and why now? Well, I think everyone's beginning to realize that if not now, but then sometime soon, everything's going to become too big to insure on a traditional balance sheet. And I think, and insurers who want to continue to keep up with this growth, meet that challenge, remain relevant, are going to need to have an alternative form of reinsurance capacity in their toolkit that doesn't have the same capacity constraints as a traditional balance sheet. And I would just say, I can't believe no one's mentioned this yet, but I think the AI data center opportunity, and no one mentioned it on the panel so far, is just emblematic of this problem. I think these are going to be incredibly valuable, concentrated risks doing very vital economic activity. We acknowledge that there's not enough capacity on a traditional balance sheet to ensure the property limits, the cyber limits, the casualty limits of those opportunities. Right. And that's in the future, but this is...
Is it in the future, though? I mean, it's happening now, right?
Oh, it's happening. Okay, by the future, it's like, wait, maybe there's a cat bond coming. Who knows?
Yeah, okay.
But it's emblematic of this theme that everything is becoming too big to insure. So it's very exciting, as you just said, Chris, for us, where we have a technology and the tool and the more and more sophisticated know-how to be able to bring our technology, the cat bond and the ILS technology, to bear on these problems. Capital markets are attracted to growth situations like this, and there's many of them. That's just one example I think I can pick, but we'll talk about cyber in a little bit, and I'm sure my colleagues will talk about other lines of business.
So that's sort of helping us with, which has always been the issue, the market is just too small, right? So I think what you're saying, Joe, is it's really not. I mean, the opportunity, if you think about casualty, if you think about data centers, if you think about protection gap, it is a very big market. And so it's okay to attract the size of capital that we're going to talk about a little bit later. Chris, what else? So we got leverage, growth.
I think it's very much investor demand driven. And I also think, picking up on Joe's comment about the balance sheet, a rated balance sheet is a great thing to use with proper diligence and judicious use of that capital, but it's levered capital, it's leverage. And we talked earlier about, we used to refer to ILS as alternative capital. It's actually absolute capital, it's real capital. And so as the leverage has come down on the balance sheet, honestly, over the last many years that I've been in the business, it has required thoughtful sort of approach to expanding your access to capital. Whether you're publicly traded, privately traded, a private company, whatever, it's the balance sheet can only go so far.
Right.
And then Bob mentioned the opportunity to bring, and there are 2 reasons why. One is volatility, so to manage that volatility. The second is the tail. And so as the alternative market, actual investors have helped solve for volatility in the property cat space, and they're starting to solve for that issue of tail, of development, of long tail casualty, offering optional products. That means that the balance sheet has to augment its capabilities with other capital sources, and so I think that's what we're seeing today in many lines.
That's interesting because it used to be alternative capital. Now it's partner capital. I think that goes to exactly what you're saying. Like, you really view as a rated balance sheet that this is capital that you absolutely have to run your business. So it is partner capital, not alternative to your balance sheet capital. Is that right? Or, okay.
Yeah, it's absolutely partnership capital. We call it partnership
Yeah,
capital.
I know you do, yeah.
And then the underlying themes, and Bob will probably pick up on this because he's been living it for a while, is certainly data, but also distribution. Right? A real trend in our business has been to find ways to access the business in a more efficient manner through, whether it's MGAs or four-letter word to some people, but there are ways to do this more efficiently and connect capital to the actual risk that I think is also a trend that we're capitalizing on now.
So Bob, yeah,
Yeah, I mean,
add to that.
I just would echo. We call it direct capital because it's a direct investment in a vehicle taking direct reinsurance risk. And our capital team gets frustrated when we talk about third-party capital or alternative capital because they view it as not the nicest way to describe our clients. In addition to kind of the evolution, I think any product that offers an attractive risk return on a cost of capital, efficient basis is going to find its way into the capital markets at some point, in some way. And we are literally all just enabling that in very productive ways. So whether you're a balance sheet capital building a hybrid vehicle that allows you to, essentially generate fee income alongside your risk-based income, whether you're a standalone collateralized reinsurer or you're something in between, we're literally trying to design product that disaggregates underwriting and capital. The best underwriting track record should attract the best capital. And the question is going to be, how do our governance, our compliance, our transparency enable that to happen? The rated balance sheets, the traditional companies are still a huge part and will remain a huge part of what we do. They are substantial, they are well managed, they have great expertise, they're great partners for us in terms of trying to deliver our product. And I always thought that casualty would require essentially a community of people working together to make it work, as opposed to maybe a specific cat bond for a specific peril that could be very focused. And I just think we're all excited about what we're seeing now.
I'm going to come back to the operational side in a minute because I want to kind of stay on expansion. So Joe, talk a little bit because, there's always like a flavor, right? So the flavor is casualty at the moment in terms of, getting a lot of attention and a lot of people talking about casualty, and rightfully so, because it could be super exciting and a real growth, expansion for the asset class. But talk a little bit about, protection gaps, some of the other things maybe that you've seen capital supporting and the protection, and even cyber. Like, what's your view on the current cyber market?
Well, cyber is a good idea, is a good topic on this one, because if you take a step back and look at the cyber insurance market, where is it now? 16 billion of gross written premium. The models are telling you the 1 in 200 year PML is twice that. So we're talking about potential industry losses of 30 to 40 billion. Those are big numbers, but those numbers can actually be happily managed on traditional balance sheets as of today. But of course, it's a market that has staggering growth projections. It hasn't been meeting them recently, but it's still growing. I think we all know in our global digital economy, cyber is going to be increasingly a product that's being bought by companies around the world. And of course, compared to property, it has relatively less diversification. Just by definition, it's not geographically definitively diverse like property, which means for a lot lower level of premium, you're soon going to reach those risk tolerance limits of traditional balance sheets, just as they were reached for hurricanes and earthquakes in the US decades ago. And that's why we've seen some forward-looking sponsors and cedents who don't need the capacity today, but they know if they want to grow into this market, remain relevant, be able to continue doing what they do very well. We want to keep insurers engaged in managing these critical risks. They're going to need to cultivate partner capital, additional capital, whatever we want to call it, to be able to grow into that opportunity. And that's why we saw them tap the market. So I think that what was interesting about that flurry of activity of 144A deals that came to market in Q4 2023 was actually an example of our market leading and innovating. Because I think at that time, after those deals cleared, there was more per occurrence cyber limit in the market in 144A form than in traditional reinsurance form.
Oh, interesting.
That's balanced out a bit now,
Yeah.
but it's an example of where I think we came to help. And while there has been a lull in activity, I don't think that should fool anyone. This market will grow, and kudos to those that have started to build the plumbing and the know-how and
Yeah.
to cultivate, investor interest. So an interesting point in terms of what can go wrong. What should investors do now? Well, I think we should be patient. It will come, and it behooves us to spend this time to learn about these new risks and be open to them. And then when those deals do come, when they eventually will, is to remember underwriting discipline and capital management discipline. So in this new risk, new market, we can achieve that sustained synchronization of supply and demand that I mentioned at the beginning.
Okay. And on the, the data center stuff, is that, like when you think about a new market, are you literally making sure that there's demand before you guys start to research and talk to investors, or how does that work when you're thinking about a new market?
Yeah, I think it starts always with conversations, right? There's something happening. And I think I mentioned at the very beginning the three things we look for. The first is something is growing faster than general inflation. It's a growth story, and that creates opportunities, protection gaps. I use that term loosely, for additional capacities. That's the first thing. The second thing, can we underwrite this risk? And I think our market has focused a lot, the cat bond market, on models. Of course, models are incredibly helpful, but does it mean we can't underwrite a deal because there's no third-party vendor model? Of course not. The insurance industry underwrites all sorts of things. So we as investors need to learn how to underwrite and make sure we can underwrite and use the information that's available, these opportunities as they arise. And then again, is there a win-win here? Is this critical business that wants to be shared with investors because it helps them, the seeding, grow into an important avenue, and AI data centers is a perfect example, or not, and if not, then we should take pause. Where's the win-win here? Where is the risk-adjusted long-term positive return for investors? Where is our capital helping? So I think that's and it always starts with conversations, and it grows from there.
So maybe going back to casualty, thinking, kind of playing on your win-win there, Danny at Ryan Specialty, how did you guys think about, putting a sidecar together? What was the reason? What was your thinking around that whole initiative?
Yeah, I mean, timing is always number one. And so you can have the greatest idea on the planet, but if timing isn't there and you don't have willing counterparties that display a sufficient amount of sophistication, you're not going to be able to go at it alone. But as it relates to data center timing, we're experiencing that at the moment, and we've all seen the headlines recently how direct or partner capital, call it what you will, is rushing to support and to play a role. There's a lot of different positions that private equity and structured credit are facing because they are heavily invested in data centers and many other forums. But we are finding at the moment that there's a natural hedge for those particular investors who are invested in these data centers to indemnify themselves via data center sidecars. So not to say that we're leading out, but we are structuring at the moment several different vehicles to satisfy that demand. That demand is robust. It's not going anywhere, but at the moment we're early days, and so they're construction liability transactions which bear a unique and discrete tail that we have to solve for horizontally. Enter Bob, forward exit option, stage left. Those particular features of sophisticated transactions are coming to play, and we're utilizing them today. So timing is fantastic. It's not always timing, but it's a desire. It's a need. Necessity is the mother of innovation. We all know that. And so we're fortunately experiencing that at the moment in a big way.
So is this, the word sophistication is kind of interesting. So is that part of why there's kind of an acceleration around the ability for us to bring new pools of capital in and do, data centers in a quicker way? Is it literally that the investor pools are just more sophisticated that we're talking to now?
I think
we're more sophisticated, or?
Yeah, I think we are all at a very unique juncture in humanity's evolution, actually.
Oh, wow, this is going to go in a way. This is good. Okay.
Yeah, get the recorder out, Steve. You want to get the quote here. No, look, it's the future is here, and it is the future. Whether you like it or not, I'm not a big AI guy, but I know that it is the future, and it's going to play a role in all of our lives. It's going to play a role in insurance. It's going to play a role in reinsurance and third-party capital. So we want to obviously skate to where the puck is going to be. We all know that it's headed in a certain direction, and there simply isn't enough balance sheet capital to support the needs and the limits for these data centers at the moment. So we don't have a choice. There's a lot of folks that are relying on us to solve for it.
I'm glad I brought up AI data centers then.
Yeah, right.
Chris, Bob, do you guys want to add anything to that, or otherwise I'll keep going here?
No, I mean, I think data centers, energy, battery storage, electric grids, telecommunications. I mean, I think of it as maybe a little bit on what Joe was describing as our 3 points. You know, if you think about it as a 4-quadrant model, what businesses are going to grow? Which ones are starting to be commoditized, and how do you kind of compare the others to create a grid view? We're probably on the diversification side, or our investors really want to see, hey, this is in some ways a new area. We'd love to see some disciplined underwriting around, casualty, property, and specialty, with a real understanding of the measurement of correlation. How do you build a diversified pool that'll be attractive to investors? And it's still a fairly customized product. Collateral design, investment guidelines, contractual terms, the size and appetite of the interest, the duration of what investors are comfortable deploying. And so I think, just to move on from data centers, because we're probably not kind of the right group just to focus on one class, our view is E&S, MGAs, capital market knowledge, our own sophistication is just the boat is floating, and the tide is rising, and the question is how to take advantage of it.
So let me kind of go, because these are things that obviously a lot of people that I've been talking to in the room are talking about, and so with casualty, and this will kind of move us into who are these new investors, who's coming into the space that maybe we haven't seen before, but it is bringing a much more, complex structure. With casualty, you might have an MGA, you've got a fronting company, you've got a transformer, you've got, so it is a very complex, is that us? Should we stop?
It's the halfway mark.
I think
we have to go now.
Yeah, we got to go now.
That's the alarm.
It is different. We've got kind of this operational infrastructure that's super good now, in terms of understanding, NatCat and how we operationalize all that. Do we need to do things just to make sure that as we grow into these other lines that we're doing it the right way? Does anybody think, are you guys thinking about that? I certainly am, that's my space, but.
I think the number one element of our product design in casualty that's different than catastrophe bonds is contingent risk and recourse. And we have to be extremely disciplined about making sure that recourse is available. Hopefully it's remote. Hopefully there's adequate collateral built into these structures to absorb most volatility. But recourse risk is a credibility issue. It's our balance sheets in terms of these structures, and we have to fulfill our promise to pay claims that, as they fall due. So I would say that if you look at kind of what it takes to make a casualty ILS opportunity successful, which is different than the lessons learned through cat bond ILS, I think it's really important that we all collectively focus on disciplined casualty underwriting for profit, being able to focus on the funded layer and the contingent layer, making sure the credit counterparty of all the parties involved in the transaction, because there are a number, are up to the task of a long duration partnership. And so I think these are things that that are elements of the design of what we're putting together. We can manage them. We know what to do collectively. We've got very good teams in the market and very disciplined. But I just think being honest about the critical parts of our product design and then absorbing and mitigating the risk of those is going to be important.
Yeah. I mean, the things that have made, this an attractive asset class so far is transparency, clarity. We've kind of moved in that direction to make sure that we can attract investors, governance. So I just want to make sure that we take all of that and we now apply that to a very different space.
There are still issues with some of those elements, right? Alignment.
Alignment, yep.
And then you have to add kind of what Bob was referring to, which is the tenure of this risk and the patience that you need. And honestly, it's an actuarial approach that is going to course correct over time. You do not have a model today that tells you what the American Bar Association is going to require as a liability and limits in 5 years from now. So it's a journey. So I think it really does come back to Bob's point, which is structure, alignment, and transparency around what you're bringing to your investors. And it's a cautious approach, but once an investor, and we saw an investment banker deck, there are no less than 48 investors looking at, and they span the spectrum, right, from family offices to institutions to aggregate to hedge funds so they're all, and some of it might be a little bit in a bubble, given where we're at with rates and private credit, but a lot of it's here to learn and to be there for the long haul. So I think that's why it can't be ignored, really.
I would add to that if I could. The casualty transactions are unique and they're so attractive for a lot of the reasons that we've mentioned before. I think Bob is 100% correct when it comes down to discipline and alignment. We at Ryan are in a unique position that we're not a balance sheet sponsoring transactions. We're MGAs and wholesale brokerage, so we don't necessarily have the alignment that you would think of in a traditional setting, but we all know that investors, they want the most unadulterated rate that they can get. They want it without it being picked over and touched 100 times before it makes it to a cat bond. They want it from the ground floor. And in order to do that, you're generally going to go through an MGA to access that unadulterated rate, as we call it. So being mindful of these points of discipline is critical for, again, a healthy, maturing asset class.
Just in defense of the balance sheet, sorry, I agree with what Danny's saying, but if your mentality as a balance sheet is to be as transparent as possible with the risk, and if you are not shedding legacy exposures or legacy lines of business that you don't like as much anymore, so I think there's an opportunity for the balance sheet to play as much of a role as the MGA does. I understand the pure nature of what Danny said, and I agree with that. But a balance sheet can do that too. But there are a few more hurdles to jump over. But to be transparent and align yourself appropriately with your investors is key.
The thing that was jumping out to me there is this concept of a long-term partner. And I think for me, just not being familiar with the private credit investor, like you guys are way more familiar, just help me understand, how do we know we've got a private credit investor that's in it for the long term? Or is that maybe not the right way to think about it? So now I want to kind of get us into a little bit the investor side. So, I think these are new capital pools, which is fantastic. I think we all agree that is what we need for the asset class. But how do we become alive to the differences, things that we should think about to make sure that it is sustainable? I think, right? So anybody, opening it up.
I think if you start with the basics, regardless of the asset class or the strategy, ALM, the ability to ensure liquidity, the question of being able to understand the fund and the fund structure and its ability to invest, the constitution of the fund, the legal agreements, and I'd encourage contract certainty as much as possible, because if this is casualty, if there's a large nuclear verdict that occurs between the time terms are agreed and final contracts are signed, you've got two different cultures. You've got one is a fiduciary for their investors and is largely reliant on the contract, and The other is a reinsurance industry that's had hundreds of years to build relationship, relationship approaches, if I can put it that way, to make sure claims are paid.
So you're doing a look-through, Bob, when you're talking to capital, you're doing a look-through all the way into the fund to say, okay, what's the structure of this fund?
To the fund, to the KYC for all of us is a part of our lives now. But yes, we do need to understand the fund that's making the investment or funds. We need to understand if there's any backstop or guarantees or some other fund that is supporting that. We need to make sure the duration of that fund, and is it an evergreen fund? Is it a family office? Does it have a strict time limit to it in terms of its investing and period? Really, we are in just like an investor has to examine us and make sure we're a valid and suitable counterparty. We do the same.
I just think in the short-term duration cat lines, we just haven't, the money goes into treasuries, it's in a trust account. These are the kinds of things I think that we need to be talking about because it is a different investor. And the fund is structured differently, potentially. Danny, what?
I think that it's important to consider what is drawing structured credit to this asset class. What is drawing private equity to the asset class? And you have to think, what do these folks do for a living? Well, they know how to manage assets, and they do it well.
Yeah.
Can they do it within guidelines that are acceptable and prudent to folks like Chris on the balance sheet side? And we are seeing, again, the evolution of an acceptance that these folks can manage these assets and achieve turbocharged IRRs to levels that make it kind of, accepting to these investment committees at these new investors. But it's not easy and it's not a slam dunk every time. I will say that there does have to be acceptable levels of assets that are investment grade to some degree or another.
Yeah, you got to kind of meet in the middle and make sure everybody's
Go ahead, Joe.
No, I would add from just a slightly different perspective from Fermat's view on casualty. Obviously we're speaking to new investors, but we are also speaking to our existing long-term investor partners.
Talk about
large
that,
institutional, large AUM institutional investors who are committed. They're not opportunistic. They're committed in the long run for different strategies. They are not diversifying again for diversification's sake. Each strategy has to stand on its own merits. First of all, does it meet the right risk-reward criteria? And then does it achieve the other, whatever they're looking to achieve, the volatility profile, the term, the duration, and the strategy has to stand on those terms. So we're speaking sometimes to the same teams, sometimes to different teams within these investors. It's interesting to hear what they're interested in. Obviously, low volatility, that's the difference of casualty, minimal per event risk. But many are still interested in that alternative, that risk premium. So for us as Fermat, we will always be focusing on underwriting discipline and looking to find that risk premium, which would be a very important buffer on returns. So it's talking to investors we already know and have deep experience and partnerships with. So it's not everyone is new.
Right.
Also, you kind of have to compare it to other capital sources, right? These are knowledgeable, to Danny and Joe's point, knowledgeable investors. If you're at the whims of the public market, you may have certain capacity today. You might not have that capacity tomorrow. You might not be as attractive to that investor source. If you're a mutual insurance company or reciprocal based, with the premise that your shareholders, your policyholders will pay those claims, and they're not as knowledgeable about the risk that you're writing, those have problems too. So it's a question of, I think, relatively speaking, these are extremely large institutional long-term investors who want to make sure that they build their own franchise value over managing money over the long term, and that you select the right counterparty with the right culture that you can align yourself with. I think it's a very, very solid opportunity for future growth.
Yeah, and I think that's absolutely right. I think there is a space for smaller investors who are willing to put in the effort. We see it in smaller MGAs, newer classes of business, sometimes distressed or turnaround situations. It's very hard to to essentially, to write on a single class basis in a small transaction where very little capital is going to be deployed when you have to put all this machinery together to make it work. And frankly, investors normally start with, what's the track record, right? How comfortable am I going to be? But it will be interesting as this evolves to see, are there investors who focus on, basically another tier of MGAs that they come up with a formula, and we assist as an underwriting manager to find capacity for them. Just like brokers have to very often struggle to find capacity among traditional players and if you will, horse trade different opportunities to make it work. There's another kind of a tranche of investors I think will emerge who are looking for better returns for the risk that they're willing to take, have a little bit more of maybe a merchant bank or equity investor mindset. But I think other than that, the larger institutions are going to be the best fit for casualty overall.
So kind of going back to sustainability, given that it is, a leverage, total return kind of approach on the casualty side, do we have to think about whether or not that changes given what happens in the financial markets? How do we think about that?
I would just take it a big 30,000-foot view picture here and say this is going nowhere, meaning it is the future. And as it's been said before, and you can quote it again, that anything with inherent risk will indeed find its way to the capital markets. And you can take a look at Taylor Swift's vocal cords to Mar-a-Lago. There's the risk of the wind blowing in Florida. That's always going to be there, and it's going to find its way to these transactions. And so it's incumbent upon us, I think, as the professionals in this room, to continue to thoughtfully craft transactions that are prudent, manage capital, manage assets well, and ultimately provide assistance to where we're seeing protection gaps.
Yep.
I think, Joe, you actually said it. I mean, we've got now the infrastructure, over the past 20 years really built up. We just now have to keep expanding that into all these new things, right? Into these new risk pools, which I'm sure we will do. Is there any other investors that we haven't talked about that you see that are having interest?
Well, I'd say on the cyber side, that's interesting, right? In terms of how investors approach cyber, and I'm sure if you spoke to any of the book runners that are in the room, if there are any, they took the 144A cyber bonds out to a broad swath of investors beyond not the normal nat cap on investors. I'm not too sure how many invested in this first phase, but just talking to our end clients about cyber. It was certainly interesting to see we educated our clients for years before we actually started putting cyber into our portfolios. They were more understanding than we thought they would be. They know they have a lot of cyber in their equity portfolios and their corporate bond portfolios, and they know they're probably not being compensated for the risk there here. Well, first of all, it's a harassing risk for companies. The solution to that harassment is insurance. And cyber insurance is a fascinating product. It focuses on aligning incentives, building resilience before, during, and after an event. And so they found cyber fascinating. And I actually can imagine down the road there being a broader swath of capital market investors behind, for example, cyber bonds than natural catastrophes, simply because it's more relevant to them. Right. So that's a different spin on seeing investors suddenly start paying attention to our market because the peril that's being seeded is just a more relevant peril.
No, I was just thinking it's probably more appealing than workers' comp. But I get your point.
It's easier to explain.
It's easier to explain. I just like the slow, predictable stuff. But there we go. Yeah, go ahead.
No, I didn't want to lose sight of the investors who have been in this space in the property cat arena for the last 20 plus years of cat bonds or private ILS. And I enjoy those conversations around a sophisticated investor with a large portfolio of property cat, maybe distributed among a couple of different managers, and the effect of a diversifying insurance line into that curve and what it does for your tail protection is pretty meaningful. And I think that's a cohort of investors that, we were talking about new investors and all these the new private credit and all that, but there are enough investors in the property cat space sophisticated enough to know that the tail can be managed in a way that within our asset class, within our business, is interesting. I imagine some of them will take the advantage of becoming sort of a quasi reinsurance company in that portfolio as well.
Okay, so I do want to leave time for questions because I think that we will have questions. So start thinking about your questions. So I want to we kind of started the beginning. We talked about what is the health of the asset class currently. So it might be kind of great to just think about the future a little bit, given everything that we've just talked about today, and maybe talk about what could be some of the defining moments for us as we move forward. I think we're all in agreement that we're excited about the asset class. But what are some of the things that we think might, I'm going to have you predict a little bit, even though nobody likes to do that, but do it.
The previous panel didn't do much prediction.
Yeah.
I was listening carefully to hear some numbers.
Yeah.
I think there was a number out there, which was 100 billion of cat bonds in 5 years' time. I mean, I did canvass my colleagues on this. I mean, the next 5 years, this market's going to look a lot more like a reinsurance market than it is today. We'll see expansion. I know we're talking about expanding our asset class. It has lots of expansion to do in that cat still. In weather perils, you mentioned things like energy. The weather derivative market has been a good job to date with those perils, but they're becoming bigger, they're becoming systemic, and they will inevitably come into our market too. I was waiting for Michael Bennett to speak more about public sector cedents. There's a lot of risk that still sits on those balance sheets. So our market's going to grow there.
Yeah.
It's going to grow in casualty. It's going to grow in cyber. It's going to grow in specialty. We look much more like a traditional reinsurance market in 5 years' time.
Super interesting. Danny?
I don't know if it's 5 years or 10 years, and I'm not going to prognosticate, but I would say that we will see within our lifetimes the ability of investors to pull up a menu and say, I want access to cyber. I want access to workers' comp returns. I want access to property cat returns. Is it going to be an app on your phone, or is it going to be to Quibs only? Yeah. I don't know, but I do know that is something that is invariably going to be happening soon.
Yeah.
Yeah, with the world we're living in today, it's hard to make predictions. And now that I know that we're at the crossroads of humanity, let's not screw it up. Let's not screw it up. Let's pick the right path, like Dorothy. No, I think there's plenty of opportunity to grow the market, as we've talked about before, and there's still pain in the market. By the way, we talked to a lot of, from a parochial standpoint, but U.S. mutual insurance companies are really struggling. And if you asked your neighbors in the street, who their insurance company is, they'd either say their agent or their local, friendly regional mutual insurance company. So there's still more consolidation. There's still more discipline that needs to come into the marketplace. That doesn't mean that the traditional balance sheets will suck all that in. I think we're going to continue to find opportunities around that. So I think the future is very bright for investors who want to think about insurance. I love Danny's vision of being able to trade it. I've certainly been in that position before, where we're trying to strive to provide QSIPs or tradable assets in the class, and maybe we'll get there someday. But I think the future's bright, and I think it will only see growth in this space.
Yeah.
Yeah, I think I'd probably just make a direct appeal. It's not a hold my beer and watch this moment like the previous session, but working with investors who understand how to transact, in a highly efficient market, watching us produce reports 30 to 60 days after a month end, produce remittances 90 days after a month end, finding out they're wrong because they passed through 4 different teams who've done accounting reconciliations, all who are tired because they're doing it on the same calendar time pressure. Please, we're spending a lot of time on software development and AI, and it's been 2.5-year effort to kind of automate end to end. We're very excited about it. I'm really looking forward to watching this industry transform.
Yeah.
Where basically net funds make it into reinsurance trusts, are invested very quickly, and investors will greatly appreciate that, and we will all benefit from it in terms of the velocity of cash flows and funds and returns. And without it, I think we really risk credibility over time.
It's going to happen. It has to happen.
But I'm hoping AI now drives it, Kathleen, where previously it was always talked about cost savings, or it was talked about as it just makes sense. I think it's going to be demanded by investors, and we are going to have to figure out how to deliver it.
Shout out to Luke. We get it.
Yeah.
We've all been.
No, you have to.
We've all felt the way you felt. Absolutely.
What somebody
It's
says may be true, even if you don't particularly like the way it's said.
Yeah, exactly.
No, we need this as an industry.
Yeah. Okay. Fantastic. So I think we can open it up to questions with a whole 9 minutes for questions. Oh, okay. Got tons of questions.
I have one for Joe. So I think you mentioned that there's about 20 to 30 investors that are willing to take a look at cyber
Kathleen
cat
mentioned
bonds.
that. Cyber cat
That
bond.
was my yeah.
No, I think it's like, I think in a traditional cat bond, there'll be 30 to 40 investors looking at a normal cat bond. And I would say it's half to a bit more than that, I understand, from the deal teams today.
Okay, because I guess the question I have is, I mean, probably a decade ago, I was talking to you about cyber models, and I think, even up to a few years ago, the market opinion was, oh, cyber, we don't trust the models, we're not going to, the investors won't invest in it.
Oh, yeah, no,
the models
it's
haven't
changed.
really materially changed in the last 5 years.
Oh, they have changed. They have actually changed. They've come down, by the way, if that's the trend, if you've not been following.
But I guess what's getting like an order of magnitude more investors kind of comfortable now?
It's the point I was making earlier. There's actually the need now to begin to think about transferring this risk to beyond the balance sheet. So, we talked years ago, right? So it was around, interestingly, it was after the ransomware pandemic that started, right? So in 2021 is when my phone started ringing with sponsors that were interested to start thinking about how can we begin to tap this market in the more ILS format. And so then I think Beazley was the first with their private cat bond in late 2022. There was more than 2 investors in that deal. We were the only one that would go public that we were investors, but let's just say there weren't many. So we've gone a long way from the end of 2022 when there was a handful of investors to, sort of the numbers that Kathleen was mentioning earlier today. So because I think everyone has began to realize this is a growth market, and that's what capital markets are there for, to support growth markets. And the primary market is acknowledging, not all of them, but the leaders in that space are beginning to realize they need to have the plumbing to the capital markets, to support growth, and if should anything happen, how do you recapitalize and continue to be able to provide that coverage, right? So kudos for them. Our market usually gets involved in markets after there's been a big disaster, after there's been a big capital destruction event. This is how our market was born. But actually in cyber, that didn't happen. So yeah, it's changed, but it's been, I would say, and that's the trend, I think, with everything I want to make clear. It's a supply-driven trend across all of these business lines. Right. It's not investors looking, where can we put our capacity? It's like, we need capacity here because this is growing, and we need that support. So yeah, things have changed, Phil.
Well, thanks.
Yep, I think we had, there you go.
Well said.
This is a question for the panelists in general. In the property cat field, the argument's kind of clear, right? It's uncorrelated to the rest of the capital markets. On the casualty side, I'm just curious, along the dimensions, I think somebody mentioned construction, pretty uncorrelated to capital markets, I would say. Cyber probably a lot more correlated to capital markets. Public-private. I understand the argument for the balance sheet when you have very large risks like data centers, but when it comes to diversification as an argument towards investors, along what dimensions are you sort of thinking about? Is it along public-private? Is it along lines of business? Is it, so what are the dimensions you're thinking about in terms of making that argument about diversification?
Well, I mean, I'd say, fortunately, casualty is a very sort of broad category of business, and so there, when you're constructing a casualty portfolio and you're measuring correlation, you do get quite a difference between just lines of business or classes of risk. You can certainly add to that other factors like, there are differences, for example, in, not our favorite class, but commercial auto, okay, in terms of, what type of goods are being transported, what type of routes are being driven, what type of experience the drivers have, what type of quality of equipment people are using. It doesn't sound like it's operating risk, but there's correlation to, if I'm transporting a particular type of goods that has commodity price risk, it's going to be more economically sensitive than if I'm doing something long-term under a contract. My view on it is it's a fairly sophisticated analysis now to build the arguments around correlation for a diversified portfolio, and investors are expecting that of us. Okay, and it's going to be far more than just line of business driven by the time we're done.
Yep, go ahead.
Daniel Perez from Nascent Group. First of all, thank you to the panel. A couple times during this conversation, the alignment topic was brought up. So my question is really, how do investors get comfortable with potential misalignment between themselves and MGAs in MGA-sponsored casualty sidecars where the MGA is not retaining any of the business that they're transferring or the risk that they're transferring? And I'm aware in some cases sliding scale commissions are used, but is the downside really meaningful enough to negatively impact the MGA if underwriting results deteriorate, or are there any other concrete mechanisms in place to address this alignment issue?
Daniel,
Sure, I'll take that. Yeah, good to see you, Daniel. Great question. The reality is whoever is going to be issuing the policy has to engage in some meaningful retention. Otherwise, you simply can't trade it. And I wish there was a better answer, but MGAs naturally you can work with some gymnastics, as it were, on the different commissions. But by and large, you're not going to get investors to the table unless there's a meaningful amount of retention done by the fronting carrier. And in that case, if that's not an option either, then you're going to have to find some version of a private Class 3C reinsurer, some degree that you're going to align with.
That's been your experience, Bob?
Yeah, I think that's right. I think the larger MGA aggregator platforms, if you look at a fractal re-type structure where the management and the company, established a vehicle in which they could take a meaningful amount of risk was persuasive. To me, the slides are, if you've got an MGA with a track record with a certain variability around its expected outcome, you're looking to see whether the slide will absorb what I'll call normal variation, right? And that slide has value for that, and it has to be meaningful. It can't just be, a swap of fees, covering the slide. If you're looking for long-term alignment, then I think you're right that it has to come more from the fronting carrier or the risk bearer, having skin in the game. And then I think lastly, a lot of the structure we put into these portfolios really place risk back to the fronting carrier or back to the MGA in certain ways, and that structure does create alignment for more remote event risk. Okay, so it's more than just the slide.
Can we do one more, Steve? Okay, one more question. If we have one, actually. Nobody? Okay, then please join me in thanking this amazing panel.